In this video, we're going to talk about trading strategies with options, and really this is a way to introduce options and to think about how options might work. So, some basic terminology. An option gives the holder the right, but not the obligation, to buy or sell the underlying asset at some time or times in the future. A call is an option to buy, a put is the option to sell. A European option can be exercised only at the end of its life, whereas an American option can be exercised at any time. In some markets, we'll see something called a Bermudan option, which can be exercised on specific dates. And Bermudan options are pretty common in the interest rate world, so we won't see a lot of that. Again, we're going to spend our time, when we're thinking about options, the easiest set of options to think about are equity options, options on stocks or indices. Now, the underlying assets for options are almost anything, right? So we have stocks, we have foreign currencies, we have stock indices, we have futures, so we can have an option on a futures contract. We have commodities, index, individual commodities, we have swaptions, and so on. So there's a huge number of different kinds of options. And what distinguishes options from futures or forward contracts is that when you enter into a futures or a forward contract, you are obliged, as long as you don't close it out early, you're obliged to either buy or sell the asset. An option gives you the right, but not the obligation to do so. So we have a bunch of specifications that we need to think about with an option. These are similar to those we've seen for futures and forward contracts. So options have expiration dates or maturities. When do they stop existing? They have a strike price, the price at which we agreed to buy or to sell. They are either European style, they mature on a single date and you can only exercise on that maturity date, or American style and you can exercise at any time. We have a call or a put. Call is the right to buy, a put's the right to sell. We have delivery details. So options on stocks, for example, could be deliverable, meaning when you buy, you actually buy the stocks. They could also be cash settled, which means that you settle for the difference in price between the price at which you would buy and the strike price. So you just make the profit off of the option. So payoff diagrams. So this is one of our key things here in this lecture. We're just going to see the beginnings of it in this lecture, and we'll talk in more detail in future lectures. So a common technique for understanding options is to draw a payoff diagram. So this usually shows the value of the option at expiry. So it means a little bit more for a European option, which can only be exercised at expiry, than an American option. Now, you will see, if you look in the literature, you'll see payoff diagrams that deduct the premium paid from the payoff. Now, this is frowned upon for a couple reasons in the industry. One, the premium you pay for the option, right? If you buy an option, you have to pay something for it. That premium is paid now, and the payoff's at expiry. So these values are at different times. And so typically we like to subtract values at the same time. And the second, which is probably not the best reason, but it's actually the way the industry thinks of it, often payoff diagrams are a means to have a discussion with a client about what they want to achieve, right? And so one might have a discussion with a client, draw a quick payoff diagram, use the payoff diagram to say, is this what you're looking for? Is this what you want? And typically, when having that discussion with a client, the last part of the conversation is how much the strategy costs, as opposed to the first part. And so by removing that premium paid, all you're talking about is what are the good things potentially that could happen in the future, as opposed to the cost today of that strategy. So we're going to look at payoff diagrams, ignoring premiums paid. Okay, so now let's first think about long a call option. So long a call option is where we own a call option. The payoff is, we often think of it as the maximum of either zero or the terminal stock price minus the strike. And so here's a picture. We look at the payoff. We can see, and this is the classic what we call hockey stick picture. So let's say first off, we've got a call option. We own a call option, so we're long the option. and it's got a strike of 5 in this case, and let's say the stock ends up at $3. Well, we have the right, but not the obligation, the right to buy it at 5. Of course, we can buy it in the market for 3, so why would we exercise that right? And so if the asset price ends up below the strike price for a call option, the call option expires worthless. On the other hand, if the asset price ends up above the strike, let's say it ends at 8, then we have the right to buy something for $5 that's now worth 8. And so on our payoff, we put a 3, right? Because we make $3 on that. We buy it for 5, we sell it for 8, we've made $3. And so that's why this picture looks like it does. So this is long a call option. We own a call option. We have the right, we've bought from someone else the right to buy this asset for $5. We could also look at short a call option. So if we're short a call option, then we've sold the right. Somebody else has the right to exercise. Somebody else has this payout. So if we've sold the right to somebody else to buy this asset for $5, then if the asset ends up at $3, they are not going to exercise the right and the option ends up worthless. But of course, if the asset ends up at $8, they're going to exercise that right, and we have to sell them something worth $8 for 5. So we've lost $3. And hence, this picture is the opposite of the previous picture. And we have a bunch of possible payouts, all of which are negative. All right, let's look at long a put option. If we're long a put option, we own the right to sell something. Well, let's look at a couple of examples. Let's look at that $8 and the $3 again. So let's say the asset's trading at $8 and we have the right to sell it to somebody else for 5. Well, we're not going to exercise that right because we could sell it in the market for 8. Why would we sell it for 5? On the other hand, if the asset's trading at $3, we have the right to sell it for 5. We've made 2, right? We sell it for 5. We buy it in the market for 3. We sell it for 5. We've made $2. Again, if we own a call option, we have a strategy where, worst case, we have something worthless. And in lots of situations, when the asset's below $5 in this case, we've got something worth potentially significant amount of money. If we're short a put option, being short a put option means you've sold to somebody else the right to sell the asset to you. Well, again, this is just the opposite of the previous one. Someone owns this strategy. We've sold them this payout, which means we owned this payout, right? If the asset ends up at 8, the other person, the person who's long, is not going to exercise the option, in which case the option expires worthless. If the asset ends up at 3, they exercise the right to sell it to us. They sell us the asset and we pay 5, and now we've got an asset worth 3, so we've lost 2. So these are our basic building blocks. And we can see this is long a call, long a put, short a call, and short a put. So these are our building blocks for option strategies. And these ones, certainly, you should just know off the top of your head, right? These should be really relatively straightforward to think about and draw. Long a call, we own the right to buy. Long a put, we own the right to sell. Short a call, we've sold the right to buy. And short a put, we've sold the right to sell. One other bit of option terminology that's worth knowing is called moneyness. We have at-the-money options, and this is not a completely strict terminology, so there's not it must be exactly at the strike, but the underlying asset's trading at the strike price or near the strike price. That's an at-the-money option. An in-the-money option means the underlying is trading above the strike for a call or below the strike for a put. What an in-the-money option means is that the option, if exercised right now, would pay out. An out-of-the-money option is one where, for a call, the asset is trading below the strike, or for a put, it's trading above. Out of the money options, one does not exercise, right? So if we're at maturity, an in the money option is one that you exercise, an out of the money option is one that you don't exercise. So if we look at this long call option, down here at the very low, where the asset's at a very low price relative to the strike, it's out of the money. When it's trading near the strike, it's at the money. And when it's trading far above the strike, it's in the money. And we'll see out of the money options, in the money options, there's a pretty significant difference in value. And then at the money options, we say they have more optionality. And why they have more optionality is because we don't know. If we think about it at the money option with a few days left before expiry, at the money call option, right? There are 3 or 4 days left. The asset's trading at $5. We don't know whether the stock is going to go up, in which case we can exercise our call, or it's going to go down, in which case we don't exercise our call. And so options that are at the money have lots of optionality. Okay, next I want to talk about trading strategies, and we're just going to introduce them here, and we'll see more complex ones in later videos. So when you apply to trade options at your brokerage, the firm's going to ask for information about your assets and liabilities, your liquid net worth, and prior trading experience. And from this, they're going to assign you an appropriate trading level. And we can see about trading levels at this optionsclearing.com. You could read more about them. But basically, there are 4 different trading levels. Different companies may assign you slightly different levels, what you're allowed to do. First, we're going to talk about level 1 trading strategies. This allows for only a safe strategy. This is known as a covered call. So if I have no experience in options, I am allowed to trade covered calls. So a covered call consists of selling a call option on a stock that you already own. It's typically traded with a strike several percent above the current trading level, the current stock price, and a relatively short maturity. Now, if the stock ends up below the strike, you collect the premium you've made from selling the call option. If the stock ends up above the strike, then you participated in the performance of the stock up to the strike. This is seen as a way to generate some income from a stock portfolio. Okay, so let's look at our picture. And what I'm going to do is combine a couple of pieces here. So that's kind of what a stock looks like, right? If I own a stock, again, ST is the terminal stock price. The stock price is the maturity of the option, right? And if the stock price ends up at 0, we've got nothing. If the stock price ends up really high, we've got the value of the stock. So we draw a straight line with slope 1. Now the call option looks like this, right? The call option, we're short the call, so it's worth 0 for below the strike, and it's got a slope of -1. You lose $1 for every dollar that the stock ends up above the strike. Now, we've got 2 lines here. We can glue these together. We can add these together. So to the left of K, all we've got is the stock. To the right of K, we make $1 for every dollar the stock goes up, but we lose that dollar for every dollar the stock goes. For every dollar the stock goes up, we make $1 from the stock and we lose $1 from the option. They net out, and we end up at some constant payout. Now, what does this really do? What this really does is it caps our return on the stock, right? If the stock goes above the strike, we don't make any more money. And what are we exchanging for that cap? What we're exchanging is we're getting a bit of cash today. So we're giving up some of our upside today in this strategy, right? We own the stock. If the stock goes up a lot, normally we'd make a lot of money. Here, we're capping our return at K, and generally that strike is a little bit above the current stock price, so we get some return over the time. And in exchange, we're getting the premium from the option. We're getting paid to enter this strategy. And so basically we're getting the premium from the option, which means we're turning future potential returns into actual payments today. So this is known as a relatively safe strategy. It's not safe because it can't go wrong. It's safe because whatever happens in my brokerage account, this can't really go wrong, right? I own the stock. I've sold a call. If the option gets exercised, then the stock disappears from my account. The strike price appears in my account, and I'm perfectly happy. So that's our covered